Structural change requires a crisis. Massive change, economic and political change, almost always through history has required a crisis. And today I want to talk about a book that was later turned into a YouTube movie, you can easily find it, by economist Richard Werner, that talks about Japan in the post-war period, into the boom in the 80s, peak in 1990, and the subsequent bust. This is really so interesting. There are so many lessons in this movie, book, or just story in general. There's so many lessons about our system. Japan has a similar system to the US. And I think probably the biggest takeaway, what I think is to distill one of the most important lessons, is that major economic and political change requires a crisis. Okay, so what this movie talked about is the boom and bust in Japan over the 80s and the 90s. Post-war Japan, into the boom in the 80s, and then into the bust. I'm going to leave aside the question of structural economic and political change here in the US right now, okay? You can draw your own opinions about that. I will leave that for a different time in terms of whether I think it would be good or bad, which ways I think would be good, which ways I think would be bad. But this question is really one that from the foundation of America as a country, there was this big debate about central banks and about one of the primary issues that some of the people against central banking had at the time was that it would give the banking industry too much power and too much power over politics. Okay, and so what we are going to see in Japan in the 80s and leading up to the 90s was that the central bank had so much power over the economy that at one point, as argued by Richard Werner, I'll talk about that later, but this economist who spent his career in Japan, he argues that the Bank of Japan was going to intentionally create an enormous boom followed by a bust. And it was the bust that's necessary to create structural, political, and economic change. Now, they probably wouldn't have been able to just create a crisis out of thin air, so they needed to create the boom first. Okay, so the boom would set the stage for the crisis, and the crisis would be necessary to create change. Fundamental to this point is that in any kind of structure, every system has groups that benefit from it. There are groups that benefit from every structure that's in place. And so changing the system is extremely difficult to do without a crisis. And this is almost a truism in general, that in order for massive change, it requires a crisis to happen. The components I'm going to talk about in this recording is that first, the Japanese has a boom. Okay, booms into the 80s. We're going to talk about that. This movie, Princes of the Yen, argues that the central bank intended for that boom to happen, that would be followed by a bust, that would create structural change, that would create the public and political and corporate awareness of the need for structural change. Okay, so this also, I would say, is a lesson in the top-down management of the economy, and you'll see where I say this. And so, in the end, of course, the central bank contracted credit, and then the whole economy got crushed. Stock prices, land prices, from the peak in 2009 until 2003. Okay, so 13 years later, land prices and the stock market was down roughly 80%. Okay, it still hasn't really recovered. That's not the prices for right now, but just to say that this was a very long and ugly process. So I also want to look at our structure compared to Japan's. We could draw lots of lessons from Japan, not just in the US, but about Europe and other places too. I'm an investment advisor. Reach out to me if you're interested in working together, but I do this because I want to provide commentary and analysis on economic and financial issues that could be followed by everyone, even if you're not a financial professional. This is information that I don't see anyone telling you. Okay, when I read the newspaper, when I turn on the TV on financial media, no one is talking about this. And so this is an observation we don't really even attempt to educate people on these issues in K through 12 education. And I think, in my personal experience, the graduate and postgraduate level education on economics is extremely poor also. Japan had a system that led from the post-war era, which I won't go into too much, but I really just want to go into the real boom era. Essentially, the system that Japan had was a top-down management of the economy. And by top-down, I mean that the Ministry of Finance, which is essentially the equivalent to the Treasury here. In the US here, the Federal Reserve is independent, right? They don't take orders from the Treasury. In the 80s in Japan, the Bank of Japan, which is their central bank, reported to the Treasury, okay? And so they had a system that they call window guidance, where the Bank of Japan would go to the large banks in Japan and specify how much credit growth was to grow in a particular year. So imagine, let's just put it in our terms, right? Imagine if Jerome Powell, head of the Federal Reserve, would sit down with JP Morgan and line, by sector and subsector, say to JP Morgan, I want you to increase lending by 15% to this sector, and by 12% to this subsector, and to 10% to this sector. Okay, line by line. So rather than JP Morgan deciding on their own who they wanted to make loans to, they were pushed to have a quota of loans to make. Okay, so this is what I mean about top-down management of the economy. And so you can see, and so as we know, and we've talked about before, this expansion of credit and contraction of credit is the main driver of what creates these booms and busts in the economy. Now in the US, we just have the Federal Reserve raise and lower interest rates, and then the big banks act in their own interests to expand credit or other times contract credit. Okay, but this was even more explicit than that, because you had the central bank that would explicitly tell the banks how much credit and who to actually lend to. Okay, and so in the 80s, by using this control that they had over the economy, they were really able to really boom the economy, right? They didn't have to wait around to see how much credit growth resulted from the central bank didn't have to wait around to see how much credit growth resulted from the central bank cutting rates, because they knew how much it would result in, because they were forcing the banks to make those loans. And of course, the borrowers, the customers of the banks, these businesses, generally businesses have ideas of what they could do with loans, right? So they have, the most productive use for a loan. Maybe they've got high demand and they could use a new factory, and they take out a loan and buy a factory. But over time, those productive demand for loans goes away more and more. And in the meantime, as the banks are still forcing money out the door, invariably they have to lend to riskier and riskier borrowers. Okay, and during this process, we saw, not surprisingly, land prices and the stock market just absolutely booming. From 1985, I think it was, to 1989, stock market went up and land prices went up by 250%, roughly, both. Not exactly the same, but 250% and the other slightly higher. And we probably remember, those of us who have heard anything about it, most people probably have, where the land prices were just absurdly high in Japan. Stock prices were too, but we would hear things like, well, just for example, the Japanese landmass is 1/26th the size of the US, 1/26th the size. But the value of the land in Japan was 4 times the size of the US. Okay, so by creating this system and really pushing credit out the door, they created a huge boom. Now, what Richard Werner argues, and I think persuasively, in the movie, is that an economist at Jardine Fleming through this period and was an advisor to the Bank of Japan also at one point in his career. What he argues is that this was intentional, that the boom was intentionally created so that there would be a crisis when the bust happened, and through the crisis, the central bankers, who are not elected politicians, right? The central bankers who are technocrats, bureaucrats, could force structural economic and political change. Okay, so this to me is that should be a big warning sign, right? Because we don't want to have economic and political change being forced by unelected bureaucrats. If there's going to be political change, it should be change that we're voting for, right? Japan is a democracy, right? So they have a political system. They had a political system then. If they want to change, then those arguments should be presented to the population. The population can vote for them. The population could be wrong, of course. They could make their own wrong decisions, but that's fine. It still should be left for the population to decide for themselves. So in this process, frenzy was happening, of course. Even manufacturing companies started to speculate in stocks and land. You know, these are all the kinds of stories you hear during booms all the time. So that's not even that special. Of course, the loans became worse and worse and worse. They became more and more non-productive. And then because of this huge boom, which had gotten totally out of control, and also inequality was explicitly used as a reason, inequality had gotten out of control too. Right? That's one of the main issues, which I argue too, that really the central bank, there's lots of reasons that we have inequality in our society even here in the US. But I think the central bank action of manipulating the price of money, which is interest rates, and driving up stock prices disproportionately and driving up real estate prices disproportionately, is really at the center of what exacerbates the wealth inequality. And that's not lost on Japan. So this was an argument that was used by Bank of Japan Governor Miyano by saying we should tighten interest rates. Now, he used these arguments about saying how they should be stepping on the brakes. But interestingly, he was part of the boom also. It's argued in the movie that he was part of the system that created the boom. And now, when the bust is happening, he's quoted in the movie as saying, thanks to this recession, everyone is becoming conscious of the need to implement economic transformation. Okay, so now the bust has happened. And now we start to see this argument that the central bank in Japan doesn't want to help heal until there is structural reform. Okay, so what they argue is that they could have been more aggressive on monetary policy, but then we wouldn't have the structural reform, and we need to have structural reform. Okay, so I will say one thing. I'm a little bit uncomfortable. These points are made in the movie. I don't agree with everything that they talk about in the movie. They make lots of other points that I won't get into here because there's a lot of what's happened in the last 10 or 15 years that I think that I just want to focus on this one point because I don't want this recording to be hours long. But I'm a little bit uncomfortable always in general with trying to say that I know what the intentions were of a certain person or group. Okay, so personally, I'm a little uncomfortable to say that the central bank in Japan created the boom knowing that they would then create a crisis and force economic change. Maybe there's great evidence for that, okay? But for me, I'm a little bit uncomfortable saying I knew what they were thinking by creating the boom, rather than the fact that maybe they just made a mistake. And maybe there was infighting because the Ministry of Finance and the Bank of Japan were not getting along well. It would be similar to, as we've seen now with Trump, where Trump and the Treasury want the Federal Reserve to do something, right? So Trump goes out and talks about the Federal Reserve doing something, and the Treasury might say the same thing because Treasury here works for the president, okay? And then that creates pressure on Jerome Powell, but he can't explicitly be fired. He doesn't explicitly work for them. Anyway, let's leave some of that aside for the moment. This is a very important point, though. Even though I'm a little uncomfortable to say that I know what their intentions were, okay? Even without knowing what their intentions were, we still can see the incredible power that the central bankers have over the economy, right? And even if we don't know what their intentions were, we can see that at some point along the way in the future, there will be bankers with intentions that maybe don't align with what the voters want, and the bankers will force change that maybe everyone doesn't want. So for example, this can read across very clearly to what's happening in Europe, right? So you've got all these countries in Europe who've joined together. The people in each country in Europe vote for who their leaders are, right? But the euro and the interest rates of the euro and the balance sheet of the European Central Bank is determined by the European Central Bank. And the bankers for the European Central Bank are not elected. We've already seen a handful of crises in Europe, some of which I think were existential crises. Okay, so when a particular country has managed its finances poorly and no one wants to buy their debt and their interest rates go sky high, the main way that this has been resolved is that the European Central Bank comes in and buys that debt and makes their interest rates in that troubled country similar to other European countries. Okay, so if the European Central Bank didn't do that, the country would essentially go bust. So think about the power that the European Central Bank has when they're negotiating with the country to have some kind of bailout. And this is even discussed later in the movie. Trichet, who was the head of the European Central Bank at a later period, this economist, Richard Werner, who's featured throughout the book and wrote the book, okay, they have a clip of him where he's asking Trichet, where in the Maastricht Treaty, which is a treaty that governs how Europe came together, where in this treaty does it give you, the European Central Bank, the ability to dictate structural change in these countries, right? You are a banker. You haven't been elected. And so how can you come in to this troubled country and say, we'll bail you out if you do X, Y, Z? And what Trichet said is that it's not in our charter, but we have a voice. Right? As Trichet tries to say, no, we don't force them to do it. We just offer our opinions and our ideas that we have a big consensus, right? So as to say, these aren't crazy ideas. Everyone thinks that these ideas should happen, and we just have a voice. But think about it. The one person who can save you, the one entity that can save you is the central bank. And as they say, well, we're not going to make you do it. We just have a voice. We're going to maybe suggest that you do it, right? You can see that this power is huge. And an earlier recording I made was even just earlier this year, where Bill Dudley, former U.S. Federal Reserve board members, was talking about Donald Trump. In Bill Dudley's view, the trade tariffs that Trump was going on in China, he thought was damaging, right? So Dudley explicitly argued, and this is in a previous recording, so I won't go too into it, but Dudley explicitly argued that if the president is going to do these bad economic deals, then we, the Federal Reserve, should not bail him out of those deals, right? If the economy goes bad because of these deals, then we should let the economy go bad. Okay, so that there's nothing necessarily nefarious about that. You might agree or disagree, right? But he goes further and says, it could even be argued that the 2020 election is in the Fed's purview. Okay, so Federal Reserve, none of these people are elected, right? But he argues that it could even be said that we should pull the levers that are available to us in order to have the outcome that we want. Now he'll say, well, it's not what we want, it's what's best for the economy. Our mission is full employment and price stability, and so that could easily translate into who's elected and what the policies are of who's elected. Okay, so this is incredible power, and like I say, I don't know exactly what the intentions were of the central bank in Japan through the boom and bust. We can see the boom happened and the bust happened, of course, and I think it's very clear to see that it was credit growth from top-down directed credit growth from the central bank through the commercial banking system that massively stoked real estate prices, the stock market. It really drove wealth inequality in society. And this is a lesson of the way that our economies are structured to work, or not work as it is. But our economies are structured to work. Of course, we're different than Japan. We've got demographic differences. We have lots of differences, of course. But in every major economy in the world right now, we have a similar system where we've got the government, and the government has a treasury that reports to the government, and then they have a central bank and floating currencies. Okay, this is the case in the UK. This is the case in the US. It's the case in Europe via the ECB. It's the case in Japan. China, it isn't the case. Okay, so China has a different policy. China has overtaken Japan to be supposedly the second largest economy in the world, but we measure the size of economies in dollars. And so China pegs the RMB and to the dollar, and so based on what we think the size of China's economy is, then China is the second largest economy. But as Kyle Bass pointed out recently, if the value of the Chinese RMB was where he thinks it's probably more appropriate to be, which is much lower, then actually the economy in China might only be half the size of what we think it is, which would make Japan still the second largest economy in the world. I recommend taking a watch of it. Lots of great lessons to be learned just from even a very high level understanding of this. Thanks.